Welcome to the Deep Dive, the place where we cut through the noise and get straight to the knowledge. Today, we are diving deep into a company that represents one of the biggest paradoxes, really, on the stock market. Charter Communications, ticker symbol CHTR.
CHTR, right.
Our mission today is, well, it's absolutely vital for anyone tracking the telecom space. We are analyzing the massive conflict presented in all our source material. Is Charter Communications trading, dramatically down from its peak highs, a classic value investing opportunity, a deeply mispriced stock? Or is it, terrifyingly, a value trap ready to be crushed by technological threats and, frankly, overwhelming debt?
Okay, so just to set the table, let's establish our anchor point. As of the analysis date, that's October 28, 2025, Charter was trading at $248.88 per share.
$248.88. And here is the fascinating hook, the sheer head-scratching disconnect. Our valuation models, based on analyst projections, suggest that CHTR is actually worth somewhere between $350 to $450 per share.
Wow, that is a staggering claim. I mean, if those models hold true, the market is pricing Charter 30% to maybe 45% below its true intrinsic value.
Exactly. So the central question is why? Why is the market so skeptical? We need to unpack the aggressive bull case that sees, a hidden gem and the equally aggressive bear case that sees a crumbling empire. Let's start by understanding exactly what this company does, what it's trying to sell you.
Okay, so Charter's core model is fundamentally pretty simple. It's built on recurring subscription-based revenue, primarily operating under the Spectrum brand. That's the name most people know. Crucially, management realized years ago that the future wasn't just in television bundles, so they strategically pivoted away from that traditional video model. They moved toward a connectivity-centric model. The battleground today is really the speed and reliability of the internet connection.
Right, the internet connection. Okay, let's detail those revenue streams then. The internet business is the absolute cornerstone, as you said. It drives the majority of their growth and, well, customer relationships. Then there's the traditional video segment. It's facing that brutal secular decline of cord cutting. It's kind of a slow bleed, isn't it? But the key high growth area that provides some defense is mobile.
Exactly. Mobile is key. They operate as a mobile virtual network operator, or MVNO. Essentially, they're just reselling a major carrier service under their own brand. And that MVNO mobile business isn't just about selling phones. It's like a defensive tether. It makes it harder for customers to leave if they have their phone, internet, and maybe video all bundled with Spectrum. Makes it stickier.
Stickiness, right. And their scale is just enormous. Charter is the largest cable operator in the U.S. by subscriber count, correct?
That's right, the biggest.
They run this vast hybrid fiber coaxial, or HFC, infrastructure, which is basically their legacy mix of copper and modern fiber.
A mix, yeah.
Passing approximately 57 million homes and businesses. I mean, that scale creates substantial economies and a pretty formidable competitive moat.
It does. But, and this is a big but, that moat is eroding quickly, which, feeds directly into the bear case. Yeah. The single greatest competitive threat they face right now is the rise of fixed wireless access, FWA.
FWA, yeah, from T-Mobile and Verizon mainly.
Exactly. It offers a legitimate, often cheaper alternative to traditional cable broadband. Plus, you've got aggressive fiber expansion happening from competitors like AT&T, pushing fiber deeper into neighborhoods. And since overall industry revenue growth is projected to be sluggish, we're talking only about 1% annually through 2028. Market share becomes everything. It's a fight for every customer.
Okay, so the strategy is clearly aggressive, fighting these threats, but strategy is only as good as the team implementing it. So let's pivot and look at the people running this highly leveraged show. The leadership team is headed by CEO Christopher L. Winfrey.
Right, Winfrey. And he isn't just any CEO. He's a company veteran, a real insider. He was the architect, essentially, of the behemoth that Charter is today. The entire foundation of modern Charter is built on those massive 2016 Time Warner Cable and Bright House acquisitions. He drove that. So he's executing the aggressive, long-term playbook he helped write. Primarily, it has to be said, under the strategic influence of controlling shareholder John Malone.
Malone's influence is key, and that playbook dictates a clear, sort of two-pronged capital allocation strategy. First is M&A, continuation of the scale strategy. We saw that highlighted by the proposed $34.5 billion merger with Cox Communications announced back in May 2025.
A huge potential deal, yeah, aiming for about $500 million in annual synergies there.
And second, and this is critical for the future, is network investment. They're deploying massive amounts of capital into the largest network upgrade since the 1990s, plus a big rural build-out to try and future-proof the business against fiber and FWA.
And how they treat shareholders really shows an almost fanatical commitment to maximizing equity value, or at least attempting to. Charter does not pay a dividend. Zero dividends. Instead, it exclusively uses share buybacks. They returned a staggering $68 billion to shareholders over the last 10 years.
Wait, let me put that number in perspective for you listening. $68 billion. That figure alone represents 178% of the company's entire market capitalization around the time of this analysis.
It's incredible.
They have essentially repurchased the company almost twice over in a decade. That shows management's overwhelming conviction that the stock is, or at least was, chronically undervalued.
But is it healthy value creation? That's the question. We look at return on invested capital, or ROIC.
Yeah.
CHTR's ROIC is 7.2%, which, okay, is higher than its weighted average cost of capital, its WACC, of 5.71%. So yes, technically they are creating economic value.
But wait, that spread, 7.2% versus 5.71%, that's only 1.5%.
Yep.
That leaves them almost zero margin for error if interest rates rise further or if operating costs jump unexpectedly.
That's a very fair point.
That tight spread confirms their strategy is working, sort of, but it's exceptionally vulnerable to macroeconomic changes. Very thin ice there.
Okay, moving on. We now need to look at the financial evidence of this competitive pressure we've been talking about. CHTR's revenue growth has dramatically decelerated. Really fallen off a cliff. It slowed from over 7% back in 2021 to less than 1% in FY 2024. This slowdown is the clearest quantitative evidence that, yes, they are losing subscribers and suffering from market saturation. The numbers don't lie.
Yet, despite the stalling revenue, operationally, they seem to be crushing it. Margins have actually expanded significantly. The gross profit margin TTM, trailing 12 months, is a hefty 55.17%.
55%, yeah.
Management is successfully squeezing more profit from each dollar of sales. That reflects strong operational efficiency and, well, that scale advantage we mentioned.
But wait, there's a huge downside, maybe the downside to that operational efficiency push. The massive debt load, the debt-to-equity ratio is extremely high. It's been ranging from 4.73 up to 5.94.
So let's translate that for you again. Relative to that competition, Charter is nearly 6 times more reliant on debt than on equity to finance its assets. 6 times. Their big peer, Comcast, sits at around 1.05.
Huge difference.
That extreme leverage, currently sitting at over $96 billion, is the single primary vulnerability for the entire equity investment. And that's exactly why the higher for longer interest rate environment hits them so much harder than others.
Absolutely. And this debt heavily influences free cash flow, or FCF. FCF has plummeted. It went from a peak of $8.6 billion in 2021 down to just $3.16 billion in 2024. Now, the crucial nuance here, and this is really the crux of the bull case, is that this decline is directly due to massive temporary capital expenditures. It's for their network upgrades.
Right. That FCF trend is the key variable we talked about. It's everything. If those heavy expenditures continue indefinitely, the stock probably dies under the debt. If they moderate as planned and FCF rebounds strongly, then the stock could soar. It's very binary.
And the market is definitely pricing in the fear right now. CHTR's current PE ratio, the price to earnings on a trailing 12-month basis, is only 6.6.
6.6? That's incredibly low for a large company.
It is. And if you compare that to its 10-year historical average PE of about 33.6, well, the stock is trading at an astounding 80% discount to its historical norm.
An 80% discount. That means the market isn't just bearish. They are pricing CHTR like a business that is, structurally guaranteed to shrink or potentially fail. That's the definition of a potential value trap. Let's see how the smart money, or at least the institutional money, is betting on this future.
Yeah, the disconnect between the data points and the price is just striking. Despite all the debt and the competition we've laid out, the analyst consensus rating is actually a strong buy. The average 12-month price target is $365.53.
Wow, $365 that implies.
Yeah.
A massive 49% upside from the current price of around $249.
Almost 50% upside, yeah. The analysts, when they model out those future cash flows, clearly see the value potential if things go right.
And there's always a but with Charter. The sophisticated market seems to be actively fighting that view. The most aggressive bearish indicator is the short interest. It stands at 16.28% of the float.
16% short. That is a very, very high level.
It is. It indicates a substantial portion of the market, presumably informed players, is actively betting against the stock. They're fueled by those debt and competition fuels we discussed.
So, here's the dilemma for you, the listener. How do you possibly reconcile a nearly 50% analyst upside target with a massive 16% short interest? Are the analysts simply too optimistic about that FCF rebound, maybe underestimating the FWA threat? Or are the short sellers missing something fundamental about John Malone's long-term scale plan and the eventual payoff from the network upgrades? It's a puzzle.
Technically, the chart is showing that the bears have been winning for a long time now. The stock is in a persistent, long-term downtrend, currently trading about 28% below its 200-day moving average. Sentiment is just deeply negative right now.
Okay, let's dig into who actually controls the company. Who owns the shares? We see high concentration. Institutional ownership holds about 81.8% of the company. So it's mostly big funds.
Right. And the key player here, the one everyone watches, is Liberty Broadband Corporation. That's the investment vehicle of the legendary John Malone. Liberty holds approximately 31.0%.
31%. That's effective control, really.
Pretty much. It means the strategic direction, that focus on massive scale, financial engineering, extreme leveraging, is heavily influenced by Malone's renowned, sometimes controversial long-term vision. They clearly don't mind the debt if they believe it creates an insurmountable competitive advantage later on down the road.
Interestingly, though, there is a positive insider signal recently. Despite some strategic selling, which you'd expect, CEO Christopher Winfrey and Director Balander made recent open market purchases. This was back in July 2025.
Ah, okay. So management putting their own money on the line at this depressed valuation, that serves as a pretty clear vote of confidence, doesn't it? Shows they believe in the current price being too low.
It's definitely a positive signal, yes.
All right, let's try to summarize the dangers here. What could really go wrong? Starting internally, the $96 billion debt load. That's number 1, 2, and 3, probably. It's the major vulnerability. We also have to acknowledge the persistent broadband subscriber losses they've been seeing. And let's be honest, the long-standing problem of poor brand perception and sometimes frustrating customer service.
Definitely. And the external threats are relentless. They're structural, not just cyclical. The core connectivity business is under attack from the unrelenting competition from FWA and fiber networks. Like we said, this isn't a temporary challenge. It's a structural shift in the market.
And here's the primary macroeconomic threat that just amplifies every single other problem: interest rates. The higher for longer environment is extremely dangerous for a company as leveraged as CHTR because it directly increases the cost of servicing and, crucially, refinancing its massive debt pile. Every extra dollar spent on interest is a dollar less available for those crucial share buybacks that prop up the EPS.
Precisely. And finally, we noted a specific geopolitical threat that emerged: the imposition of U.S. tariffs in 2025 on goods from China. Now, this poses a direct risk by increasing the cost of critical network components. Things like modems, routers, optical gear. It just makes the entire massive network upgrade cycle significantly more expensive than they originally planned. Another headwind.
Okay, let's boil this all down. Let's try to synthesize the two sides of the bet you'd be making here. The bull case argues, look, the stock is historically cheap. PE of 6.6, 80% discount to history. That's compelling. The current FCF suppression. Bulls say it's temporary, caused by a strategic CapEx cycle that will future-proof the business. And management's aggressive buybacks will ensure huge earnings per share growth when, not if, FCF rebounds.
Okay, but the bear case argues that low price is entirely justified. It's cheap for a reason. The reason is the crushing debt load, which makes the company highly vulnerable to interest rates, as we just discussed. And bears point to the structural erosion of the core business due to superior fiber tech and aggressive FWA competition. They think the spending will never truly stop. The upgrades will need more upgrades.
So the ultimate tension remains the intrinsic value versus the market price. That educational discounted cash flow, the DCF model we mentioned, estimates the intrinsic value is somewhere in the range of $350 to $450 per share, which confirms that if the bull thesis works out, this is potentially a phenomenal opportunity from $249.
Right. But the stock's current price of $248.88 is undeniably a massive discount. It indicates the market is currently wagering pretty heavily that the bearish risks, the high debt, the intense competition will definitely materialize and overpower the potential upside.
So bottom line, an investment today is really a bet. It's a bet that management's long-term strategy of network investment and share reduction will prevail. It's a bet that FCF will rebound significantly before the debt service costs become paralyzing. It is a classic high-risk, high-reward value play, not for the faint of heart. And that brings us to our final provocative thought for you today. Given Charter's status as a mature, almost utility-like business with historically predictable cash flow, how much leverage is financially responsible? Where's it cross the line from simply amplifying equity returns to becoming a dangerous systemic risk for the company? Think about where that line truly lies. If you found this deep dive useful and want more actionable knowledge delivered quickly, make sure you check out the rest of our analysis at Stock Analytics AI. We cover all 500 stocks in the S&P 500. And next up, exclusively for members, we are diving deep into the NASDAQ 100. Members can also request stock deep dives. Just drop the ticker in the comments and we'll turn it around for you. Pretty cool feature.
And just before we go, we have the required note for everyone listening. Please remember, this analysis was generated by an AI system. It's purely for educational purposes only and is absolutely not financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions based on this discussion.